Ready. Okay, good morning. Today we are going to finish up Chapter 3. We have 2 homework problems to do, a couple questions, and then at the end of class I'll take questions about the exam. We'll use whatever time we have left. So just a reminder what's due this week. Sometime today before 5 p.m. or before, the attendance quiz will become available. That's over material we would cover today, Tuesday, and then some of it might relate back to last Thursday because we did start Chapter 3 last week. Chapter 3 homework in My Accounting Lab is due this Saturday, and there is no video quiz due this Sunday. Because we have an exam coming up next week. The next video quiz is due Sunday, February 23rd. I'll send a reminder email, but you could do that anytime. So whenever you want to get into that to do it, but there is no video quiz this week. Some announcements about next week. So next week we don't have class. My office hours are changing due to a conference I'm attending. So I will have office hours next week, 8 a.m. to 1 p.m. on Tuesday. So if you want to see me, it's going to be Tuesday. I'm always reachable via email. I do have some flights in there next week, but I'll put an away message up if I'm going to be gone for more than a few hours. So don't, I am still totally reachable. So I will be in my office 8 a.m. to 1 p.m. on Tuesday next week. So the week of the exam, if you need me, see me Tuesday. There is no tutoring next week because of the exam. Today is the last opportunity for tutoring. There are still some spots if you want to go. Haley is tutoring today from 12:30 to 1:30, 1:30 to 2:30, and she's in room 503. Good to sign up ahead of time, but she'll take you if you don't sign up today, I'm sure. When you take your exam, you need official photo ID, a driver's license or a Kent State ID with your photo on, or a passport, something like that. You'll need that whether you take it in the lab or whether you take it on ProctorU. You do need photo ID, official photo ID. The exam, and I'm just going to flip through these pretty quickly. The exam is February 18th through 20th, so Tuesday, Wednesday, Thursday next week. No class next week. We have the exam. The exam starts roughly 8 a.m. on Tuesday. It absolutely ends Thursday at 9 p.m. And you should be, if you're taking the exam in the computer lab, if you're sections 1 or 2, you do not schedule your exam. You wait in line potentially. Usually you don't have to wait in line Tuesday or Wednesday. That would be rare, but not unheard of. But Thursday, there's a very high chance of waiting in line because there is at least one other exam ending on Thursday besides ours. So there's about 600 people needing to finish their exam by Thursday night. And human nature being what it is, people end up putting it off, and there could be very long lines in the afternoon or evening. So if it were me, I would be scheduling, I would be thinking about taking it Wednesday. If you're taking it ProctorU, you need to schedule your exam at least 72 hours in advance. If you don't schedule it 72 hours in advance, you can still take it, but you'll have to pay a convenience fee. I think it's $5 or $6 or something like that. And whether you take it in the lab or in ProctorU is dictated by what section you're in. Your exam will not work in the opposite place. Just a reminder, I've gone over this a lot, so I'm not going to dwell on it. You may have one piece of paper for the exam, one physical sheet of paper. You can write on both sides, and we've said this a few times, but both sides, and one piece of paper only. Reminder, never to have your cell phone visible or audible. Silence it, turn it off, and put it away before you take your exam. Where you would find the definition, I'm jumping into the chat room right now, so I'm going to take over steal your thunder here. Where would you find those definitions for the words on the study guide? Textbook, okay? Read the chapter. Let's see. The paper has to be blank before we go, right? The scratch paper has to be blank. You get to take a reference sheet with you and you can write anything on it that you want. So that one's not blank before you go. You can have one sheet of paper with writing on it, either side, both sides. If you violate rules, I have to report you to the Office of Student Conduct, so don't do that. Do not take what I've said in class as being the only thing you need to know about the exam. Do go to exam information on Blackboard. I will tell you, if you write me a question and you say, can we, for example, if I get an email and it says, can we write on both sides of the sheet of paper for the exam? My response to you is going to be see exam info on Blackboard, because that tells me there's other things you don't know about the exam either. If you ask me what days the exam are, I will tell you to look at Blackboard. You really do need to look at the exam info on Blackboard. It is tailored to how you're taking the exam. Study plan, I'll just emphasize again, study plan is the best way to prepare for the exam. And let's see, the last. And now we're heading on to the first question. So at the end of class, I want to allow plenty of time, but at the end of class, I believe we'll have plenty of time for exam questions. But right now, before we move on, anybody have any questions for me right now? It's not our only chance, but this is one chance. Any questions about the exam? Yes. Am I going to tell you if the exam is going to concentrate on certain areas more than others? Well, you know it's over 4 chapters, and I've put information in study plan, so, and on the review sheet. So I've pretty much given you what it's going to be on, okay? Anyone else? Do we have any? Your exam sheet can be written on both sides? Okay. Yeah. Okay. Oh, so we're going to start with the first question. We will have time at the end of class. I'll be asking again if you have any questions. So if anything occurs to you, we will revisit this again before the end of class. First question, what will be increased when a company receives cash before performing the services? Which one of these items will be increased? First of all, we know right away what's one item that's not on here. What is increased when we receive cash? Cash, yeah. So cash is one thing increased. There is one other item increased. So that's on this list. So I'll give you a minute or so to come up with an answer. I'm switching now. Yes. D, okay. What do you think? Pardon me? Okay. How do we move? I have no idea how that moves. You can't. Oh, okay. I'll get there. My people that are in front, am I on the right side yet? No. There. Okay, there. It'll catch up in a minute. Clearly. Yeah. There we go. Does that work better? A, okay. An answer, I think? C, okay. I have A, B, and C. What do you think? C? 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 What do you have, Brian?
I have B and yeah, 40. 5 Ds.
26 Cs and how many Ds now? 6 Ds. Okay. The answer is indeed C. Unearned sales revenue. What kind of account is unearned sales revenue? A liability. Excellent. Yes. Unearned sales revenue. Remember, it's a liability. We're getting cash before we actually perform the services. And just down in the corner of this, I wrote the journal entry so you could see what would be going on here. We're debiting cash because cash is increasing. We're crediting unearned sales revenue. That increases unearned sales revenue because a credit increases a liability. And if you're asking why does a credit increase a liability, I would refer you back to the debit credit handout. It's on the home page of Blackboard. It has those rules about what increases what. At this point in your learning, it's best just to use the rule sheet and work your way through it. But that is the entry for receiving cash before performing service. And unearned sales revenue is indeed a liability. Next up, a homework problem. This homework problem that's coming up, it's exercise 3-24A. We're going to do several adjusting entries. Yes, we're supposed to journalize the adjusting entry needed at December 31st for each situation. Each situation is unrelated to the other situation. So we have 6 journal entries to write. There's some overlap between what we did on Tuesday with these, but these again are very good entries to know, to have on that reference sheet. First one we have is the business has, situation A, the business has interest expense of $9,600 that it must pay early in January 2013. What this is telling us is the business has incurred this interest expense in 2012. It's not paying it till 2013, but it needs to recognize this interest expense in 2012. So to do that, we're going to debit interest expense and credit interest payable. We debit an expense to increase it. We credit a liability to increase it. But we don't have to memorize this entry either. Whenever we have interest expense that we need to accrue for, this is the entry. It's always going, if we're talking about interest that we have to pay, that we're going to pay later, but we've already incurred it, we're going to debit interest expense, credit interest payable. We did one on Tuesday where we had interest earned, and that entry debited interest receivable and credit interest revenue. So you just have to make sure which side you're talking about, but this should be a very easy entry to deal with because it's always going to debit interest expense and credit interest payable. Brian? Video. Do you need to change the moderator? Change. Okay. Okay. Interest revenue of $4,900 has been earned but not yet received. Do you have a question? Okay. So if we earn interest revenue, this was what I was referring back to on the last one. When we have interest revenue that we've earned, we're going to debit interest receivable. We're going to credit interest revenue. So we are increasing an asset, which is interest receivable. This has future economic value for me. I'm going to be getting this interest. It is interest receivable, and then I'm crediting interest revenue to recognize this revenue that I've earned. I just haven't received the cash yet. The next entry down, on July 1st, when the business collected $12,000 rent in advance, so July 1st, it got $12,000 of rent in advance. It debited cash and credited unearned rent revenue. So what's going on there, they're increasing their cash and they're increasing a liability. That unearned rent revenue, whenever we see the word unearned, remember that's a liability. The tenant was paying for 2 years of rent. Now this is July 1st. So the tenant is paying for 2 years of rent. We're doing our adjusting entries as of December 31st. So that means we have 6 months of rent revenue that we need to recognize. So the first step we're going to do, the first thing we'll do is we'll figure out how much rent per year this is. There's a couple ways you can approach this, but the first thing I do is I say we get $12,000 for 2 years of rent. That means that's $6,000 rent a year. Okay, so that's step one. And again, you can approach this whatever way makes sense for you, but my next step is we are talking about this taking place. We got it July 1st. This is December 31st, so this is only 6 months of that rent. So I'm going to take the $6,000 times 6 months out of 12 to give me $3,000. So that's how I get to the $3,000. You can get to that $3,000 any number of ways, but that's one way. But that's what we're doing. We're saying we've actually earned $3,000 of that unearned rent revenue. So our liability, before we do this adjusting entry, our liability is too high, and we also don't have the revenue recognized. What we're going to do then from a journal entry standpoint is we're going to be debiting the liability for the $3,000 that we've earned, and we're going to be crediting rent revenue for the $3,000 as well. And again, that calculation is not part of the journal entry. It's just there to show you where that number came from. Our next entry, entry D, tells us salary expense is $1,900 per day, Monday through Friday, and the business pays each Friday. This year, December 31st falls on a Thursday. So the end of the financial period, we need to recognize that we have 4 days of salary expense in 2012, and we have 4 days of liability in 2012 as well, because December 31st fell in this problem on a Thursday. So what we're going to do, I think I have a typo there. That's 1,900 times 4, I believe. I think the number's right. 1,900 times 4 is 7,600, right? Any calculators in the room? Brian? Pardon me? Thank you. Yes, they beat you online. So. Okay. Okay. So yeah, thank you. Yes. Okay. And so it is salary expense is 1,900 times 4. So the 7,600 is right. That was simply a typo. Sorry about that. So we're going to recognize salary expense and credit the liability to recognize we have a liability there. So 1,900 times 4. I can't fix that one right now. Next situation, the unadjusted balance of the supplies account. Supplies is an asset, so the unadjusted balance of the supplies account is $3,200. But the total cost of supplies on hand is $1,400. What this is telling us is right now the balance on the trial balance would be $3,200. But when we count it, when we look in the closet, it's actually $1,400. The reason it would be lower is because we use supplies. So we have to first calculate how much we use. And how much we use is going to be the difference between those two items. So the 3,200 minus 1,400 is going to be 1,800. So we are going to see supplies expense debited for 1,800 to represent what we used, and we will credit supplies for the 1,800. Now for our last one. F, equipment was purchased at the beginning of this year at a cost of $80,000. We purchased that equipment, say January 1st or right around there. The equipment's useful life is 5 years. Okay, and it says there's no residual value. Residual value is what something's going to be worth at the end of the life, and we have to do one calculation if we have residual value. We don't. So we're going to learn a lot more about residual value and depreciation in a later chapter. But for right now, we can take our $80,000 and divide by 5 years. If we take 80,000 divided by 5, that's 16,000. So our journal entry, every depreciation journal entry is going to look exactly the same. We're going to debit depreciation expense, credit accumulated depreciation. This depreciation journal entry, very, very standard. Depreciation expense debited, accumulated depreciation credited. Accumulated depreciation is a contra asset, meaning it's shown with the assets, but it reduces assets. On entry F, it does have one little bit of this requirement left that we haven't done. We've done the entry, but the very last sentence, the last half of the sentence says, determine the equipment's book value. Book value is the equipment's original cost less its accumulated depreciation. So it's basically its original cost less all the depreciation taken to date. So what we're going to see on this particular one is we are going to see book value equal to 64,000, which is 80,000 minus 16,000. That 16,000 that you see there is the total of accumulated depreciation. It's not, this is a very fine point. It won't make a difference in this one, but it would make a difference in other situations. That 16,000 that we're using is accumulated depreciation, which is a running total of all depreciation to date. It is not depreciation expense. Depreciation expense is once a year, and then it goes back to zero, which gets us to closing entries, which we do next. So just a minor point, when we're calculating book value, I mean, it's pretty major, but it's one thing right now. You take original cost less accumulated depreciation. Accumulated depreciation is not interchangeable with depreciation expense. Accumulated depreciation is a running total of everything you've depreciated to date. Those adjusting entries we did in combination with the ones that we did on Tuesday are good to have on your reference sheet. They can get you through a lot of situations. You don't have to reason your way through a closing entry or an adjusting entry when you have it listed there. What we're going to switch to in a moment is we're going to look at closing entries. So we had adjusting entries, now we're going to closing entries. But before we do that, we are going to get to a question which is right behind those the adjusting entries. How can it load the bottom before the top? That's weird. Okay, let's do that. Now we're going to, hopefully it'll load correctly this time. Well, I have 3 people who can see the question. Yeah. There we go. Company started the year with 400 of supplies. During the year, they purchased an additional 1,200 of supplies, and there were 700 of supplies on hand at the end of the year. What's that adjusting entry look like? What do you think? Can you narrow it down to 2? Okay. I'll come back, but look at the supplies journal entry, because the adjusting entry we just did. You could narrow that down to 2 if you look at that. So. What about you guys over here? You have an answer? See? See? What about you? Okay. 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 What do you think? C? Want to go with, yeah. C? What do we, C? Okay. Do you have a lot of C's? I have a lot of C's. Okay. Sometimes that's a good thing, sometimes not. Yeah. In this case, it is a good thing. We would have supplies expense for 900. I do want to point out one thing. If you could figure out how many supplies you used, you would know the answer without knowing the journal entry. Okay? Or you could do this by looking at the entry on your sheet. Let's say this is just exam strategy. Let's say you have your reference sheet and you've written all the adjusting entries on it like I've suggested that you do. So you look through your adjusting entries and you find the supplies adjusting entry, and I think we just did it. And the supplies entry is always going to debit supplies expense and credit supplies, right? So you could look down through here and say this answer could only possibly be C or D. So if you had to take a guess, you could at least narrow it down to one of 2, and you're going to have a better percentage on the ones you don't know. But in this case, what you're doing to figure out the supplies, again, you can reason your way through. We started with $400 of supplies. We bought another $1,200. So that means we had $1,600 of supplies to use. It tells us we have $700 in hand at the end of the year. We must have used $900, okay? Because the $400 plus the $1,200 is what we had available. The $700 is what we have left. We have to pull out the $700. That $700 hasn't been used yet. So that's why we go with the $400 plus the $1,200 minus the $700. Beginning inventory plus what we purchased minus what's on hand at the end gives us the used. And we did that on Tuesday. I would refer you, we had the formula on Tuesday. Now we're going to transition over. We've done adjusting entries on Tuesday and part of today. Now we're going to transition over into closing entries. And this process, when we have this accounting cycle, what happens is we have transactions during the period, we record them. At the end of the period, we make all these adjusting entries, and so our accounts reflect economic reality, and then after we're done preparing the financial statements and all that, we have to close our books. And when we close the books, it prepares the accounts for next period's transactions. Is basically, and I repeat it twice, that's very important, is closing the book. The purpose of closing the books, closing entries, prepare the accounts for the next period's transactions. That's why we're doing closing entries. When we close the books, when we close these accounts, we're making them zero. We don't close all accounts. We only close accounts that are called temporary accounts. Temporary accounts, the three of them begin with RED. If you remember the acronym RED, revenues, expenses, and dividends. Those are our temporary accounts. The reason we have to close them is when we talk about a company's revenue for this year, we're talking about this year's revenue. We're not talking about revenue from last year. We need to start the year with zero. Similarly with expenses, these aren't our expenses from the beginning of time. These are our expenses for this period. Same with dividends that we've paid out. Now, the accounts that are not temporary accounts, you might want to make a note of this if you don't have it noted elsewhere, is permanent accounts. Permanent accounts are the other ones. They're everything except revenues, expenses, and dividends. So permanent accounts are things like assets, liabilities, common stock, retained earnings. Basically, permanent is everything that's not a revenue, expense, or dividend. Permanent accounts have balances that don't go away simply because it's the end of the year. The one that I always like to think about is cash. Cash is a permanent account. On December 31st, our cash balance doesn't reset to zero. It continues. We still own the cash. We still own buildings, which are assets. We still owe our mortgage. That's a liability. So permanent accounts don't go to zero. But we want revenue to be at zero the first day of the year so we can keep track of revenue for this year. We want expenses to be zero. So this closing the books process is to prepare the accounts for next period's transactions. Basically, we're zeroing out revenues, expenses, and dividends. These closing entries are going to be virtually the same over and over. So we're going to do an exercise, and these closing entries I would definitely write on my sheet as well. I would have a little box off to the side with the three closing entries. There's closing entries for that RED acronym. There's a revenues closing entry, there's an expense closing entry, and there's a dividends closing entry if indeed you have dividends. This exercise says here's a bunch of accounts. Okay? They give us a lot of accounts. We don't necessarily need every one of those accounts. Well, we don't need every one of those accounts. And it asks us how much in net income did North Shore earn during the year, prepare a T account for retained earnings to show the balance of retained earnings. To do what they're asking us to do, we essentially have to prepare the closing entries. So even though it doesn't say, well, at the very first sentence it says prepare the closing entries, and then we have other requirements. So we're going to start with the closing entries, and I put the acronym RED up there because there is a revenues closing entry, and that's the one we're starting with. We're going to start by doing the revenues closing entry. Revenues closing entry is basically wiping out our revenues. So we're going to do the opposite of what increases revenues. So again, going back to that debit credit handout, we would see what increases the revenue. We do the opposite thing to close it. Alternatively, if you write this entry in the corner of your sheet somewhere as the revenues closing entry, revenues closing entry, you will locate every account that is a revenue, you will debit those accounts, and then you will credit the total of those accounts to retained earnings. Lots of times you only have one revenue account. You'll have sales revenue. Other times you'll have sales revenue, interest revenue. So you could have different revenue accounts, but you find every revenue account, debit it, and then credit retained earnings for the total. That credit here to retained earnings, that's your total revenue for the period. This is the closing entry for revenues. So write it down. You could have one revenue debit, you could have two revenue, however many revenue accounts you can locate in the list of data, that's what gets debited. The total gets credited to retained earnings, and those are revenues. That's the revenue closing entry. That's the R in red. Now we move on, and for the expense closing entry, what we're going to do is we're going to locate every expense we're given, and we're going to close it out. And to close it out, we need to do the opposite of what increases it. The opposite of what increases an expense is a credit. So what we're going to do next is we're going to locate every expense account. And if I go through the list, I see cost of services sold. Cost of services sold is that first one, $11,000. Remember that when we see cost, that's an expense. Cost of goods sold, cost of services sold, that's an expense. Moving down, selling and administrative expenses, $6,400. Moving over to depreciation expense, it's $4,100. And then finally, income tax expense, $500. You write down every expense account, you credit it. So once you add up those expense accounts, you're going to add cost of goods services sold. You're going to add selling, general, administrative expense of $6,400. Yes. That's what I'm saying. Just hold on 30 seconds. Okay? We're going to take cost of services sold, the $11,000. We're going to take the selling, general, administrative expense of $6,400. We're going to take the depreciation expense of $4,100. We're going to credit income tax expense for $500. So we have those four credits. Those are what we have to close out. We add them up because our debits have to equal our credits. If we add those four numbers up, that gives us the debit to retained earnings. Remember, whenever we do a journal entry, we have to make our debits equal our credits. We know all the credits in this example. We are going to add those up, and we will debit retained earnings. It doesn't particularly matter the order that we put those in, except, hold on, it went backwards. Maybe I clicked it. So I got click happy. If you can't see, you're going to have to exit out and come back in. That should fix it. Sorry. This is a closing entry for expenses. When you have a closing entry for any group of expenses, it's going to look like this other than the credits. The names of the expense accounts will vary with the situation. Every single expense that you're given, you need to write a credit for. When you're done writing all those credits, then you add them up, and that is your debit for retained earnings. Remember when someone asked if the order of the accounts was important, and I said no. It's not important within the credits, but remember our debit has to go first. So our debit's first, and that's, we can calculate it later. We know we're going to debit retained earnings for the total of all the expenses. So we're going to credit cost of services sold, credit the other three accounts. So we add those up, that's where our $22,000 comes from. And that is our expense closing entry. if you're writing this on your exam sheet, you're going to be debiting retained earnings, you're going to credit, and you can just write all expense accounts. That's what you're doing. And then your debit to retained earnings is the total of all those expense accounts. That's our expense closing entry. Now the last closing entry we do, there's 3 closing entries. The last one is dividends. This is dividends we've paid out. The problem may or may not have dividends. Sometimes companies haven't paid any dividends, so they might not have the last entry. But when we look through our list, we see dividends in the right-hand column about halfway down, 300. So the closing entry for dividends will be to always debit retained earnings for the 300, credit dividends for the 300. These are dividends that we've paid out. The exam will look exactly like study plans. Or you can have multiple choice, so you still need to know how to do it. Yeah. What we've done so far now is we've prepared the closing entry. So we've done the first sentence up at the top of the exercise. Our next, okay, I think that's a good question. I'm going to share it with everyone, that one. Okay? The question is, how come in the first problem with our retained earnings was listed last, and with D&E retained earnings is listed first? With closing entries, you have to do the opposite to revenues as what increases them. So revenues, so here's our closing entries that we did. In the first one, the R entry, we have to debit the revenues because we have to make them 0. So they have to be debited, so then retained earnings is the other side. Again, if this doesn't make sense, I would urge you, write down these entries. When you close revenues, it is always going to debit revenues and always credit retained earnings. We're zeroing out revenues. Now when we get to expenses increase with debits. So to zero them out, to cancel them out, we have to credit them. So we're crediting all the expenses and debiting retained earnings. And finally, with dividends, dividends increase with the debit. And again, I know that from looking at my debit credit handout, looking at those rules. So to close them out, to cancel them out, I have to do the opposite. So I will credit dividends and debit retained earnings. Again, these are the closing entries. They're always going to look like this. We may have different revenue accounts, but all the revenue accounts will be debited. We may have different expense accounts, but all the expense accounts will be credited. Dividends will be credited if we have them. And then retained earnings is the opposite of each of those. Now the last box on here, one of the questions was, how much net income did the company earn? Well, net income, going back to the most fundamental formula, net income is revenues minus expenses. My revenues were $24,300. That was that credit to retained earnings. My total revenues, if I add up all my revenues, they were $24,300. My total expenses were the total to retained earnings of that second closing entry, the expense closing entry. So we have the $24,300 minus $22,000. Okay. Remember, and we said this several times, dividends never, ever, ever, ever impact income. Okay, so the boxed item at the bottom is answering one of the questions: how do we calculate net income? The very last requirement for this problem, the closing entry for dividends will always be exactly that if you have dividends at all. So you will have exactly that entry with only one account or nothing if you don't have dividends. Okay. So that's the easy one. It will always look like that. The last statement says, prepare a T account for retained earnings to show the December 31st, 2012 balance of retained earnings. Before I leave this screen, I want to point out one number. In the first column, bottom number, it says retained earnings December 31st, 2011. That is our beginning retained earnings balance for 2012, what we ended 2011 with. So retained earnings started 2012 with $2,600. Retained earnings is considered to have a normal credit balance. So now I'm going to draw the basic T account, okay? And our basic T account, keeping in mind that retained earnings, $2,600, that's a normal credit balance. If they had brackets around it, it would be a debit balance. Okay, so there's my first, this is what I'm setting up. I haven't finished this requirement, but this is a T account. T account, we draw the T, write the name of the account at the top, and then we're putting in that beginning balance there. And that's a credit balance. Retained earnings has a normal credit balance. And if it were a negative, it would be on the debit side because then it would be opposite. But we can just, this one will, I'm pretty sure even in the homework it has a credit balance because retained earnings has a normal credit balance. We have this T account. That's the beginning of it. We've put the beginning balance in. Now what we need to do is look at our closing entries and pick up every entry that impacted retained earnings. So any entry that said retained earnings. So I've circled them. See how we have retained earnings credited in the first entry, in the red entry, the revenues entry. The second entry, retained earnings, was debited. So we have the expenses of $22,000, and then we have retained earnings debited for dividends. So those three numbers I want to call your attention to because there's retained earnings in each of those numbers. So what we're going to do then, going back to our T account, is we're going to post those to that same T account that we had set up. In the little corner, those were the entries. So my expenses were debited. I'll put it a debit in retained earnings account. Dividends were debited. I'll put them on the debit side. And then the revenues were credited. So I'm posting them. When you do this, we started with December 31st, 2011, $2,600. Then we put in the expenses and the dividends. We put them on the left side because they were debits to retained earnings. We put the revenues on the right side because they were credits. And then what we would do is we would draw that line that goes all the way across under dividends and revenues. So we draw a line. And what we're saying is we're going to total the account now. And the total of the account, what we do is we would take the difference between the two sides. So I would add up expenses of $22,000 plus dividends of $300, and I would have a total in my calculator somewhere, not in the T account itself. And then I would add up, so I would get $22,300 on one hand, and on the other hand I would add the right side, I would add $2,600 plus $24,300, I would get $26,900. So I don't write that anywhere. So I have these two sides. So then I take the difference between the two sides. So I'll take the difference between $22,300 and $26,900, and I get a difference of $4,600. So I know my balance of retained earnings is going to be $4,600. How do I know which side it's on? It's the side that's greater. So on the left side, we've got $22,300 total. On the right side, we have $26,900. The right side is greater, so retained earnings is a credit balance of $4,600, and that's where the balance comes from. What we just did by putting the $22,000 in the retained earnings account, putting the $300 in, putting the revenues in, we posted the closing entries. That's what that process was. Now remember, on closing entries, we're closing the temporary accounts only. So we're closing revenues, expenses, and dividends. We do not close permanent accounts. With that then, we've got a question. You have to identify which of the following accounts are considered permanent accounts. So a chance to try that out. Have an answer? You're between. That doesn't have anything to do with it. So think about the red accounts are temporary.
Yeah.
So think,
what revenue is or dividends. That's why I wasn't sure. I'm thinking for the
good reasoning, yeah. Yeah. Okay, on this one, we think about, as I was saying here, we got an answer B, and B is the answer. Do you have a lot of B's? Okay, you have a lot of B's online. Okay, now, the temporary accounts are revenues, expenses, and dividends. As I go through these, entry A, cost of goods sold is an expense, so that kills entry A. In entry C, revenue is a revenue account, so it can't be C. D, salary expense is an expense account, so it can't be D. So it has to be land and accounts receivable. Both of those are assets. The permanent accounts are assets, liabilities, and the equity accounts like common stock and retained earnings. I'm going to take exam questions now, just to remind, because that does it for the formal work, the formal material for the coverage. Just a reminder about what's due. A reminder about what's due this week. Just keep in mind that Attendance Quiz 10 will be available sometime 5 or before today. And Chapter 3 homework, not Chapter 4 homework, it's Chapter 3 homework. And then the video quiz 11 is not due until February 23rd. There is no video quiz due this week because of the exam. So speaking of the exam, we have no class next week. I have office hours from 8 a.m. to 1 p.m. on Tuesday. If you have any questions about the exam or anything, stop by and see me on Tuesday. The exam is available Tuesday, Wednesday, Thursday. Exam information is on Blackboard. So, questions? Anyone? Okay. Anyone have questions? No? Okay, well I hope you all do extremely well. Use Study Plan. Make sure you can do everything in Study Plan, and I'll see you in a week.